am what you call a price action trader. Okay. To really understand price action means you need to study what happened in the past, then observe what is happening in the present, and then predict where the market will go. Price action traders, on the whole, don't rely much on technical indicators. We rely on what is happening on our chart, on our price chart, and what price is trying to tell us at the moment, because price never lies. Now, price action is among the most popular trading concepts. A trader who knows how to use price action the right way can often improve his performance and his way of looking at charts significantly. However, there's still a lot of misunderstanding and half-truths circulating that confuse traders and set them up for failure. In tonight's class, we're going to explore some of these strategies and understand what price action is. So, what is price action? Well, it's a favorite among short to medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and the investor's ability to read the market. Many investors see the stock market as an information exchange where all views and strategies meet and try to arrive at a fair price in the end. This explains why price action trading strategies do not involve fundamental analysis of an individual market or commodity. Now, in our short-term trading, we don't care what the fair market value of an asset is. We are only concerned with whether we think that asset from this point where it is right now is going to go up or go down. Now, we don't care that the euro is really worth 136 to the dollar and is trading at 106. A little we do, but we're not here buying euros to put them away for when the euro goes back up. We don't care that Facebook is worth $462 a share technically, but it's trading at 465 and it may go down to 462. We only care that right now it's dropped to 459 and we think it's going to go back up to 462. We don't care whether 462 is a fair value. We care what price action at the moment is telling us to do and what its potential is. So, as many of the decisions associated with price action trading are subjective, what one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you effectively ignore the experience of investors in favor of cold, hard trends. Human nature dictates the futures and commodities prices can be extremely volatile. Overbought and oversold situations are often created because of fear and greed. While panic selling can take over the events of disappointing news, these are the types of scenarios where price action investment strategies can prove to be extremely potential. The key to reading price action charts is to take in short-term fluctuations. It's also critical to notice emerging trends and focus on patterns, which repeat time and time again. Like my favorite, triangles. I'm a hardcore chart pattern trader. Okay. Now I believe triangles consist of triangles, wedges, anything that's got two lines converging at each other. You'll hear a lot of talk about swing patterns, support and resistance, wave analysis, trend lines, and moving averages, name but a few different chart patterns. Candlesticks and bars are also very popular. For example, when a chart is about to crash through a support level, it is unlikely to do it in one fell swoop. Now, when you have your support and resistance levels drawn on your charts, and these are drawn based on history, and if you've got them correctly, and hopefully you do, there's no law, no rule, no guarantee that price won't just sail through that support or resistance level, but most likely human nature is going to cause it to hem and haw there for a few seconds. because all the traders know that that level is significantly important, and they're all waiting to decide whether to push it up or take a breather, or maybe it's too overvalued at that point. So you may see an index or a commodity contract price initially bouncing off the support level as investors look to benefit from the short-term sell-off. As short-term traders sell into the bounce, buying interest begins to wane as sellers again take control. Now imagine in your mind, okay, we're going to come up with an XYZ company scenario. We know X, Y, and Z company always has a problem breaking through $95. Every time, now it's trading at 92, it's very happy at 90. But every time it goes to approach that $95 level, it hems and haws and bounces off of it. Now, we know that most traders, especially the large traders, they enter the market with an exit point. They know how much profit they're looking to make off that trade. When you're trading in a bank, you're trading millions and millions of dollars. You're not looking to say, oh, maybe it'll go up $5, maybe it'll go up 5.25. You're going to set a preset a sell. Okay. Now we know that 95 is a hard price to break. We might set our sell right at 95, 94.50, 94.25 because we bought it at 90. We're happy to take our profit and go home. So we know as traders that at $95, as price approaches that $95, it's going to trigger lots of sell orders. These were the sell orders that made people lots of money, that they were already in the market and they were very happy. They got out with profit. You have others who set up sell orders that's saying when the price gets to 94.75, sell me 1,000 shares, because they know that the resistance is at 95 and it's going to most likely bounce back to 92, maybe 90. And so all of this is pre-set up. So as we're sitting back watching as a trader, we know something's going to happen around that 95 level. Now, that doesn't mean all this is going to trigger and everything's going to do exactly what we say. But these are statistically the odds it'll happen there. Now, once all these buy and sell orders are wiped out of the market, the price could turn around and continue going straight up. But we know something's going to happen at that 95 level. Okay. What's going to end up happening after that, we don't know. But we do know something will happen there. So if we're looking to buy, we might wait for it gets triggered at 94.50, 94.75, 90, whatever, and let it bounce down as low as can go before we enter the market. And we've got this from observing price action. So eventually the price will crash through the support level, often promoting an array of short selling. So how do you read price action on your charts? There are many different types of chart patterns we associate with price action trading. Some of these are fairly obvious, while others are often open to interpretation. And price action and your interpretation of price action is what makes you better than the guy sitting next to you. Once you understand what they really mean, you will start to notice many of them on your charts. So let me pop up a live chart here for a minute. I got several live charts set up for us to take a look at. Now, as I mentioned, I always have my support and resistance levels set up in my charts. Now on this chart you're looking at, this is my standard teaching chart, but you're looking at purple dashes, green dashes, you're looking at green solid lines. These are color codes to me. This is my legend, but these are important support and resistance levels. And these levels extend on your charts all the way in the future. You don't have to draw them on there today. When the euro dollar goes back up to $1.20, $1.30, the lines I drew up there 6 months ago are going to appear forward. So once you have all your lines in your charts, they're there forever. Now keep in mind that right now the euro is trading at just about the lowest value it's ever been down here at, down here at 98. Okay. that means the euro is worth way less than the dollar right now, which has never happened in the past. So to draw a support and resistance levels on at this price is very difficult because the price has never been here before. And with an asset that we're experiencing where the price has never been, we have to set these new lines. So right now I'm using color-coded red lines and putting on each level that I think is strategically important. Why I'm using red? Because I'm telling myself, so next week, I know when I look at these lines on my chart, the next time, that these are relatively untested levels, and they're very short-term new levels because there's a, see, when you see my dark green line here, that's telling me that's a very important tested level. The dashed green lines tell me they're fairly new, but they're very important levels. The purple line tells me that's a fairly new level, okay, but it's held for quite some time. Okay. These help me make my decisions when I'm looking at my price charts to know how important or how significant these price levels are. Because when I look at my chart, and like we said, the euro's hardly been here, but look at this price here. Look how important this price has been for the euro while it's been trading at this level. So that tells me that that's a significantly important price. And so as I go back on my charts, I can also see how that level is held up. And, you know, like I said, at this value, we haven't seen the euro here ever. And so these are fairly new, but look at this. We're all the way back to last month, and we can see how significant this price level has been. So it tells me something. And now if I'm a price action trader, and this is a live chart, what would I have been doing today? As I saw the euro crash through this significant level and start coming down, I would have definitely been selling short today, because it's now telling me the euro is broken down. Okay. But this is just by looking at my price. Okay. And now I've set these new levels, but look at where the euro is here. But this is just the first. You can't make a trading decision simply based on lines on a chart. But it's your first step in reading price action. And by having all these lines in your chart, you're not just coming up today and putting things on your chart and trying to figure things out. Okay. You have some understanding of the past, the present, to help you predict the future. Okay. Now, here we look at the euro pound. Let me clean these markings off the chart. Okay. But here we had a very important daily support level. We had a local resistance. Now, these are just like my purple and green lines, thick lines, thin lines. Now, please keep in mind, when you're looking at your support and resistance levels, these are not finite, defined, exact to this, decimal to the pip price. My head always tells me that when I have a support or resistance level on my chart, I give it 5 pips in either direction. Okay. Or a lot of times I will draw on a zone, because price doesn't, if the euro is trading at 0.989919, is it important if it's trading at 0.99189? No. We have to say it's a zone, okay, because it's not a finite price. It's a small zone, but you can't just say that one particular level, because we're dealing with 4 pips to the right. But when we see the reaction to these levels, okay, we can combine it to make decisions. We combine that with things like volume, or things like chart patterns, or specific candlestick patterns. And I'm not talking about looking for 3 black crows and 3 white soldiers. I'm talking about looking at the wicks and the bodies of the candles at each one of these price zones to understand what price is trying to tell you as it reaches each one of these zones. Now, there's things like bullish head and shoulders. Okay, a head and shoulders pattern is thought to be a very telling pattern if it appears on the charts, and it really is. Except in our type of trading, it takes too much time to develop, and the fact is, most of us don't even notice on the charts. We'll see it on our charts after some, analyst has written up there that it's forming a head and shoulders pattern. And believe me, these patterns aren't as well defined as we think they are. You know, a head and shoulders pattern can be simply a neckline with, you develop the shoulders and then the center head, which is higher than the shoulders. It's like the human being. This is a bullish head and shoulders because it means the price is going to move up. But you can have a bearish head and shoulders, double bottoms and double tops. Okay. I don't rely and use double bottoms and double tops for anything. I don't think in our type of trading, it's helpful at all because price hits two price levels quickly and bounce and bounce. But once we get to a triple bottom or triple top, now I'm starting to see something. It was like looking at our price chart and we saw the price hitting up the resistance level, hitting the support level, hitting the resistance level. Well, when you see it make a triple bottom or triple top, our price is trying to tell us something. Now, one of the more unique patterns, and it's kind of telling when you see it on price, is a rounded bottom. Price is easing down, easing up, easing down, easing, but making a nice rounded bottom. When we see this rounded bottom pattern, it tells us that price is most likely going to reverse and move in the opposite direction. And then, as I said earlier, we have my favorites, which are what I categorize them all together as triangles. When I was in school, we learned about triangles. A triangle had a base, an apex, and three sides. Two sides moving at each other at same angles or different angles, and a base that was flat. So I don't care whether it's a symmetrical triangle, a asymmetrical triangle. I don't care if it's a wedge. Anytime you have a support and resistance line converging at each other to form an apex, you have a triangle. And what we're importantly looking at is the breakout of that triangle pattern. And when that breakout happens at a strategic support or resistance level, we have price trying to tell us to do something very important. So whether we have an ascending triangle, a descending triangle, a symmetrical triangle, a wedge, okay, we are looking and waiting for the price to tell us something right in front of us. We're not looking at technical indicators. We're not looking at fundamental information. We are looking at the price on charts and waiting for the price on the chart to tell us what to do. So the key to any successful price action trading strategy is to remove peripheral noise, such as fundamental data, and look at price patterns, trends, and other forms of technical analysis. Now, in price action trading, one of the most important confirmations is volume. Now, we have to understand that when we trade and use volume as an indicator, it's not like we're trading stocks in the stock market, because the stock market can tell you to the penny, not to the penny, but to the actual stock, what the volume is. The commodities market can tell you exactly how many contracts in each time level, that have been, initiated or closed. Okay. When you're trading CFDs, you're trading them through your broker, who's then placing them through a market maker. Excuse me, a market maker. The volume on our charts are based on what's being pushed through this liquidity provider or the market maker. Now, it has been fashioned to all of us that this is not exact volume, because especially in Forex, there is no exact volume because there's no centralized exchange that's watching everything. So on your charts from a CFD broker is the volume based on what's being put through the liquidity provider. Now, it's formulated that all these liquidity providers around the globe are providing the same amount of trades. So therefore, the volume assumption on our chart gives it the same move in volume that everybody would have if we had a centralized exchange and put together. So one of the key aspects of price action trading when using support and resistance levels is the fact that once a support level is breached, it can then turn into resistance and vice versa. So keep that in mind. I simply use the words support and resistance. Okay. A lot of times I'll teach you to use price zone or price alert, because I don't look at is price moving up and hitting resistance or falling down and getting support. I just know what it's doing, because when price flips through resistance, it becomes support. And when price breaks through support, it becomes resistance. So if you close your eyes and imagine elevator, and the elevator is moving up, each floor above is resistance. But as it moves through that floor and goes up to the next floor, that the floor under your feet is supporting you. When you were moving up towards it, it was resistance. When you're coming back down, it becomes your support, and it just reverses. So all we need to know is these are the steps on the ladder going up and down. These are the floors on the elevator going up and down. So Charlie's a house painter. He's got his ladder out there. The ladder has 20 steps on it, to get him to the roof. The steps, when he's going up, is what he's climbing up. When he goes down, he's climbing down those same steps. When he's going back up, and if he only goes up 6 steps and then comes down 3 steps and goes up 6, these are still the same steps on his journey. So if you think of support and resistance that way, these are just the steps on the ladder or the journey of the price. Now, another way of seeing price action is by what we call pin bars or inside bar combos. And this is using a bar chart instead of a candlestick chart. Now, in the days where candlestick charts were so easy to use due to the new Java charts and HTML charts, most of us traded with bar charts. And pin bars and inside bars, or mother bars and baby bars, were an important clue to what price action was telling you. I still use them today, because today you can click on your chart and change it from a bar chart to a candlestick chart in about a second. So a basic pin bar and inside bar combo is already a good sign. When you also see the inside bar form within or near the pin bar nose, that it's even a stronger signal. The pin bars on the chart are talking to price action traders. Those who learn to understand their language can set them up easily. So when we're using candlesticks, we have the candlesticks name for them. When we're using bar charts, we call them baby bars and mama bars, pin bars and inside bars. Candlesticks, we might call them bullish engulfing and bearish engulfing. So many price action traders are extremely vigilant. They're always on the lookout for what is known as inside bar patterns. They can recognize these easy by the emergence of a secondary bar within the body of the previous bar. Now, what is that called in Japanese candlesticks? I believe it's a Hammurabi. It's a small bar, a small candle fully contained in the previous candle. Okay. Bar in bar charts, it's the secondary bar, it's the baby bar, mother bar. Okay. So you can see here in a bar or a candlestick pattern, the last pattern was here. The new price action is fully encompassed within the body of the previous. This is called an inside bar pattern. Okay, this bar is fully contained within the body of that bar. The primary bar is sometimes described as a mother bar and will often indicate a period consolidation and potential turning points from key support and resistance levels. So when these patterns appear and they appear directly on your support or resistance level, they can tell you exactly what price is trying to tell you. So when these appear and they appear right at your price action level, your price level, your step on your ladder, it's trying to tell you something. Price is screaming out to you as a trader. Hey guys, I'm telling you something. Listen to me. So don't forget, it's only when you take the time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget to also keep one eye on stop loss limits. As you've gathered from the above information or from all the information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It only goes stronger when an opposing trend emerges and the direction changes again. In between these relatively strong trends, there will be periods of consolidation or sideways trading. A price often bounces off support and resistance. In many ways, support and resistance levels are self-fulfilling prophecy. But when you have price action trading because you've got a new trend emerging that should have momentum, or you're in the consolidation period, you have opportunities presented to a price action. When price is bouncing up and down between these levels, so Bill's on his ladder, Bill's painting the wall, and he's up on step 6. He has to go to 7, step 8 to raise up and reach under the window, and then he has to go down to step 6, 7, 6, 5. Then he's going to climb back up to 5, 6, 7, 8. Well, Bill's painting the outside wall of the house. The windows are all up at that level for the second door, so you can tell that Bill's going to be going up those 5s, 5, 6, 7, down 7, 6, 5, up 5, 6, 7. And once you've emerged this pattern, now Bill may end up between the windows and go up to 8, 9, 10 and go back down to 7. But you can visualize Bill moving up and down that ladder while he's painting. You see the same thing in price action. So don't act with a trade until the market itself confirms your opinion. Being a little late in the trade is insurance that your opinion is correct. In other words, don't be an impatient trader. Once you can see how Bill's going up and down that wall, and you've analyzed up and down, see where the windows are on that wall, and see how long that wall is, you can make a smart decision. Now, there's many disadvantages of trading with price action. There are numerous disadvantages and advantages to using price action trading strategies, and ultimately it comes down to how disciplined you are as a trader. But there are relatively a low number of trades. What you get is you won't get many trades, but when you see all these things come together, you will have a high probability successful trade. So you want to wait for definitive levels. Unfortunately, traders using price action trading are often caught out by significant shifts in the market. This often means prices do not return to their preferred trading levels. For those lacking discipline, they can end up chasing the price higher and higher. Meanwhile, for those who are able to remain focused on the technical situation, opportunities will emerge. Many of the strategies you mentioned above are overcautious by some people. While waiting for a definitive change in trend, there may be times when intraday price could spike above resistance or below support and then recover. These could be false flags and could be potentially expensive in the long run. Too many traders, especially with online trading, want to trade. Me on a busy week when I'm actually spending time trading a lot and not teaching and writing analysis, what? I might get in 4 or 5 trades. That's it. Most of the guys I know that are trading online are getting 4 and 5 trades in a couple hours. So it depends on how many assets you want to watch and what other strategies you're using, because the market may not be setting up, or this asset may not be setting up for this particular price action trade, but it might be setting up for that. But you want to wait for something, and you want to make sure you close your ears to fundamental analysis, because it can get you off base, because you can try to make yourself expect something. I'm not saying there's anything wrong with fundamental analysis. What I'm saying is, depending on how you're trading, but you don't want to go in having a biased opinion. So as we touched, while price action trading is based on technical analysis and reading of the situation, and the reason I say technical analysis, anything you do on a chart falls in the field of technical analysis. I like to call it chart analysis. It's not always cut and dry, but there's many different ways. For instance, after hitting a new high, an exchange rate might fall back as a result of profit taking, or low volume is sideways trading. But the simple answer to the most important question, does price action trading demand discipline? The simple answer to this question is yes, in the right hands. Price action strategies can highlight periods of consolidation or the emergence of a new trend or the phases of sideways trading. The key is to see what's in front of you and what your chart is trying to tell you to do. The basic difference is that price action incorporates both technical analysis and human input. Effectively, you are monitoring emerging trends and reading these with varying degrees of discipline and experience. While there is a degree of human input with regards to price action trading, there's also a need to be disciplined, even if you're marginally missed out on several trades. The idea is blunt. When the turning point occurs and the momentum builds for a new trend, you will be there. So keep in mind, you can use simple reading of price action on your charts to make important trading decisions. So thank you very much for joining us tonight. Have a great trading week, and thank you for being part of the Alvexo family. Good night now.